Let's say that you have money on the sidelines that you're looking to invest. Maybe you had an inheritance that you received that was an inheritance in cash that you now want to get to work on your behalf. Maybe you've just downsized your house and then now taking equity from that house and wanting to invest that. For whatever reason, you might have cash on the sidelines. Well, the age-old question is, should you invest that all at once or should you invest that slowly over a period of time? Should you invest that as a lump sum, or should you dollar cost average that into your given investments? Well, this is exactly what we're going to cover in today's Wealth Wednesday. Let's get into it. The classic question here is, what is the best way to invest in whatever you're going to invest in? Should you invest all of that money over time? This would be considered dollar cost averaging. Or should you invest that all at once? At one point in time, invest the full sum that you have sitting on the sidelines and invest that going forward. This would be considered lump summing. Okay, and just kind of big picture looking at these two, and from a visual standpoint is, let's say that we have $250,000 sitting on the sidelines. Again, let's say it was an inheritance and we're now looking to invest that money. Lump summing would be whatever time frame we're looking at. We're investing this all in one day into that given investment and allowing that investment to grow and do its work. With dollar cost averaging, what we're doing is, again, whatever time frame we're looking at dollar cost averaging over, we're taking that $250,000 into equal contributions into the market, and we're simply averaging that through time. And so it's all at once or slowly through time. Okay. And what is the big fear with lump sum investing? Again, why would this lead somebody to look at dollar cost averaging? Well, let's specifically look at investing into stocks. And so the big fear is essentially what we're looking at here on the left side of the screen. What happens if we invest at the wrong time? Okay. If that lump sum, if we invariably take that lump sum, we invest it in, and it just happens to be that we picked the wrong day to start investing or the wrong month to start investing. And so that's essentially what we're looking at here on the left. We're looking at the COVID crash of 2020. And we saw that, let's say that we invested $100,000 into the stock market at the top of COVID. We just had the worst timing ever. And we lump sum invested. Well, we know exactly what happened over the preceding weeks. The market fell 35%, and that $100,000 immediately turned into $65,000. And so a lot of the whole idea behind avoiding lump summing and moving towards dollar cost averaging is really kind of loss avoidance and regret avoidance. Because again, obviously, if we invest at the wrong time, that could mean danger, if you will. And obviously, we know the market recovered and whatnot, and you'd still have more money today than you would have had at that point in time. But again, it was bad timing. We, looking at dollar cost averaging differently, we would have seen that by a dollar cost averaging, let's say, and this would be a pretty quick dollar cost averaging time frame if we were dollar cost averaging all the way down. We would have obviously been buying at a lower price. So our average price for what we bought into would have been lower through dollar cost averaging. And we would have not only lowered volatility, but probably gained a little bit on the upside as we're dollar cost averaging through market downturns. So this is the big fear around lump sum investing. Well, in order to gain any type of conclusion, we have to all agree on a few things. And hopefully everybody watching this video agrees on these few things. But we have to agree that we expect our wealth to grow over the long term when we invest. Otherwise, we shouldn't be investing at the end of the day, right? If we're expecting that we're going to lose money investing, well, then we should hold in cash and not make that given investment. And so we have to agree that over the long term, again, this might not be the case in the short term, we expect that money to grow. Okay, so that's number one we have to be able to agree on. Number two, we can't predict financial markets reliably. Okay, so we have to also agree on this. Otherwise, there'd be no point in dollar cost averaging. We would specifically lump sum, but lump sum on whatever day made the most sense if we could predict financial markets. Okay, we know that we can't predict financial markets. Okay, we can look into history and have some data, and we're going to cover a lot of that data in today's video, but we can't predict the market. Again, if we could predict the market, we wouldn't be having this discussion. Okay, we would lump sum on the right day, or maybe even again, if we rather than lump summing right here, we'd short the market. Okay, but we can't predict the markets, so we need to understand that. That's number two, and then number three, we have to obviously we have to agree that the money that we're looking at investing is not money that we need in the short term. Again, if we needed this money in 6 months and we just sold our house, we now have $250,000 because of selling our house, and we need to buy another house in 6 months, well, we shouldn't be investing that money, at least in riskier assets like the stock market, because again, the odds that that money has grown 6 months later, those odds get to be a lot more of a, not necessarily a coin flip, but much closer to a coin flip. And there's a lot of risk that we're taking. So we obviously, by investing this money, we know that we don't need it in the short term. So we can be long-term about it. We have to agree on these things. And if we agree on these things, we're going to show that the data becomes a little bit more black and white, all things considered. Okay, so let's go through first a thought experiment here. Okay, and by going through this thought experiment, I'm really trying to just set a foundation for, again, we'll cover the data, but how should we think about this whole discussion between lump sum investing and dollar cost averaging? Okay, so you just inherited, let's say, $500,000 in cash. Again, the amount does not matter here. You need to invest it. What specifically, let's think about right now's environment. And we're investing in stocks, let's say. So we're in this Ukraine-Russia kind of mess right now. That's very unfortunate. We've seen financial markets be a little bit more volatile because of this. You have $500,000 that you want to invest that's sitting in cash. Would you invest it all today over here? Or would you choose to invest it over the next 12 weeks? Okay, asking this question, if we just poll, let's say 1,000 people, I think the majority of people would probably be over here on this side, right? Maybe you're at a different opinion, okay? What about over the next 12 months? Okay, we're just looking at a slightly different time frame now. Well, now I'm guessing that it's probably a little bit more where all of a sudden the people that were over here in the 12 weeks, some of those shifted over here to the invest it all today. Okay, why is that? Is that too long of a time frame? What if we extend that time frame to 12 years? So you're going to invest it all today in more volatile markets, or invest it evenly over the next 12 years. Well, now I would guess almost everybody should be over here in the invest it all today category. So what changed here? Okay, the only thing that changed is the period that we're looking at dollar cost averaging over. So we can all agree that there is a period where it doesn't make sense. There is a fine line, if you will, that it makes more sense to invest it all today if we're looking at too long of a period. Okay, so keep that in mind. What are we trying to accomplish by investing it over 12 years? Are we trying to cover our risk in terms of investing all in one day and decrease volatility? Are we trying to go for the largest growth? What is our goal there? But we know that dollar cost averaging at the very least has a line where it no longer makes sense. Okay, so now let's start kind of going through the data, and we're going to cover a lot of data. I want to make sure nobody gets lost in all of the numbers that we're going to cover, because the data is very important. But again, as we just throw a bunch of numbers on the chart and throw numbers on the screen and charts on the screen, it can be a little bit confusing. So I'm trying to explain this off the front end here. So we're going to show charts that look like this, okay? And here's what we're going to look at. We're going to look at, on a rolling basis, we're going to look at a dollar cost averaging period. Let's say that's 12 months. Okay, so basically what we'd be looking at is lump sum investing a sum of money on one day at the start of this period, or equally over 12 months. Okay, we're going to be looking at historical data from 1972 till 2022 in a bunch of these different asset classes. And we're going to be showing a chart that looks like this. Okay, this is basically an outperformance chart where we have this line here that's 0%. When the data points are above this line, it means that lump summing outperforms. When data is below this line, it means that dollar cost averaging outperforms. Okay, and basically what this shows is a rolling chart moving through time. So what we're looking here is, if we start this period in January of 1972, we're basically looking at, okay, if we lump summed in January of 1972, or we invested over the next 12 months, okay, we're looking at the differential between essentially what would have been the better option. So we see right here, this is about right around 5%. So from January of 1972, investing lump sum would have gained about 5% more than, and outperformed dollar cost averaging by 5%. Okay. If we look here, this might be, again, it's hard to see, but this might be something like, 74 or something, 1974, one of those months in 1974. So now we see lump summing would have underperformed dollar cost averaging by over 10%. And so all we're doing with each additional data point is basically shifting by one, okay? Shifting by 1 month. So the next month we're looking at February of 1972 until February of 1973 and so on. So it's a 12-month rolling period here, and we're looking through all of these rolling periods, okay? And again, we're looking at percentage difference versus an outperformance of lump sum versus dollar cost averaging, okay? So let's look at stocks first. Let's look at one of the more volatile assets. Again, we would expect that dollar cost averaging would work better in stocks because of the volatility. Again, that's the whole idea here. Dollar cost averaging is trying to avoid that volatility and trying to avoid the regret of investing on the wrong date, if you will. So what we see here with this lump sum outperformance chart, we're looking at a 12-month time period. So investing all in one day or equally over the next 12 months. Okay, we're looking at a time frame between 1972 to 2022, and we're looking at U.S. stocks. Okay, historical. So this analysis is historical. Portfolio is 100% stocks. I'm going to shorthand this just so it's easy. So this is lump sum, and this would be dollar cost averaging. Okay, and what we see here first between again, if we were looking at dollar cost averaging over 12 months or lump summing all at once, lump summing wins in stocks 76% of the time. Okay, we see here on the chart, again, looking at the 0% line, anytime that we see this above the line over here, it means that lump summing is outperforming dollar cost averaging. So we see the majority of these trials where lump summing wins. Now, again, this is very counterintuitive for many people because, again, in the volatility of stocks, you would think dollar cost averaging typically wins. Okay, and again, winning is, there's a little bit of gray area on winning. Winning in terms of this would be in terms of return. There's also a volatility risk element that we need to be considering as well. I'll talk about that here in a second. But let's keep going into the data. So on average, and again, we're just using $100,000 in terms of what we're investing over a lump sum or dollar cost averaging period. The average gain on lump summing would be 12%. Okay, the average gain that we would receive, the performance that we would receive from a dollar cost averaging standpoint over a year was only 6.41%. Okay, when lump summing wins, okay, so when lump summing is over here in this category right here, when lump summing wins, on average, it outperforms dollar cost averaging by 8.58%. Okay, when dollar cost averaging wins, so over here, dollar cost averaging wins and outperforms lump summing by 6.8%. So this is a very important concept. Okay, when we're investing and beginning any investment strategy, ideally we want asymmetric risk return in our favor. Okay, basically what this means is, let's kind of use a more hypothetical example. If we had an investment strategy that won 50% of the time and lost 50% of the time, but when it won, we got a 10% return, and when it lost, we got a 3% negative return. Okay, that's a winning strategy through time. We're winning more than we're losing. Now we're winning and losing at the same rate, but the asymmetric risk return trade-off there is in our favor. So that's a little bit what we're seeing here with lump summing and dollar cost averaging. When lump summing wins, we win by a greater margin than when dollar cost averaging. There's more to gain on the upside than we're risking on the downside to dollar cost averaging, if that makes sense. Okay, but let's keep going further into this. What happens if we're looking at a different dollar cost averaging period? So we see that lump summing wins on average. Okay, but let's look at different time frames. So what you'll notice here is the shorter the time frame, and this should make sense, the shorter the time frame, the closer we get towards a coin flip. And again, this makes sense because the shorter the time frame, you get closer to just lump summing. Okay, if you're lump summing on 1 day versus looking at a 2-day dollar cost average, it's basically going to be the same results. You're basically going to be a coin flip, and when you win, when lump summing or dollar cost averaging wins, it's not going to win by that much because it's just a 2-day difference. Okay, so we see the same thing with the shorter periods of time and the longer periods of time. This again makes sense. At 2 months, lump summing wins 62% of the time. And when you look at the average lump sum gain versus the average dollar cost average gain, the difference is lump sum wins on average by 0.5%. Okay, at 6 months of a dollar cost averaging period, 71% lump sum wins by about 2.5%. Okay, we've already gone over the 12-month time period that we just showed here. 24 months, okay, 82% of the time lump sum wins. 36 months, 82% of the time lump sum wins. So the longer period of time that you're looking at dollar cost averaging over, the more that it will make sense to lump sum or look at a shorter period of time. The more that you're extending some of those contributions, the worse results, again, on average, you will receive. And again, it's important to look at basically a histogram of these results. So again, we're basically looking at, again, 0% here on the right side of the screen. This would be the number of trials we see. There's about 589 trials that we looked at throughout these rolling, shifting 1 month for a 12-month period here. And we see lump sum outperforms over here on the right, dollar cost averaging on the left. And again, not surprisingly, we see, and this is good that we lay it out in a histogram, because basically what this is going to show is the vast majority of trials, once again, it's skewed to the right. It's skewed towards lump summing winning. The reason that's important to look at this is because if we had, let's say, some tail end trials here that were up 30%, that were bringing up the average, that would be fairly alarming. It means that, again, there's a lot of volatility within the, whether lump sum or dollar cost averaging wins. But we see that, again, it's fairly a normal distribution here. with it with lump sum kind of tilting towards lump sum, if that makes sense. Now, the common objection that will be received or will be voiced here when talking about dollar cost averaging versus lump sum is dollar cost averaging decreases volatility. And we should be factoring in volatility and risk here. And you're 100% right, but I also believe this is a little bit of a moot point, all things considered. By definition, dollar cost averaging will be less volatile. Here's just a very kind of rough example here of dollar cost averaging versus lump summing through 4 months. Okay, and what we see here is, again, this makes sense that there's a larger dollarized difference either way with lump sum investing. It's more volatile on a dollarized basis because you're taking $100,000 and investing it right into the market versus taking $8,333 and adding that on slowly over time each given month. And so it makes sense that as we see dollarized changes, they're going to be much greater in terms of lump summing than dollar cost averaging. So volatility 100% will be less in dollar cost averaging. But this is only for a short period of time. This is only over that dollar cost averaging period of time. So we're looking at a very short period of time of lesser volatility because at the end of that dollar cost averaging period, we have the same amount in lump sum, or we have we're fully invested. So the volatility from there on out will be equal. Okay. Again, because basically the volatility only decreases during that short period of time that we're dollar cost averaging. And so what real reprieve are we getting from a volatility standpoint, from a risk standpoint? Okay, I would argue we're not getting that much. It's for a very short period of time, as long as we're dollar cost averaging through that period of time. Okay, so that decreased volatility and decreased risk is, again, only for a short period of time. And again, we want volatility to the upside. Again, ideally, again, we expect our investments to grow over the long term. So we expect lump summing to win over the long term as well, because we expect that growth. Again, historically, we've seen that. Let's look at another asset class. So not just looking just purely at stocks, but looking at more of a balanced portfolio. We'll just use the traditional 60-40 of 60% stocks, 40% bonds here. Once again, we see these same things playing out. Okay, so this lump sum chart, looking at the exact same period of time, looking at the pretty much the same exact metrics, 12-month dollar cost averaging period and such. We see the vast majority of trials, once again, lump summing wins. In fact, when we're adding a little bit more safety and we're decreasing the volatility here, lump summing wins more, okay, 82% of the time rather than 76% of the time. Again, this makes sense because the big risk there is the volatility within stocks. It's the that we may be down a significant amount and then dollar cost averaging helping us. But when we're adding to a balanced portfolio and we're adding some safety in, we're having much less volatility on an ongoing basis. And so we're expecting more consistent growth, okay? The average lump sum win or gain is 10%. That's about double what the average dollar cost averaging gain is. Okay, the advantage when lump summing wins, the advantage that you have over dollar cost averaging on average is 6%. When dollar cost averaging wins, on average, it has an advantage over lump summing by 3.8%, almost 4%. Okay, and again, we see some asymmetric things play out here once again. The top results here for where lump summing won, it won by almost 28%, according in comparison to dollar cost averaging. When dollar cost averaging won, the greatest kind of change was only 15%. So we're seeing some of these kind of asymmetric trade-offs again. And so you see less risk in lump summing in a more balanced portfolio. Once again, when we look at these different time periods, the shorter time period, the more it becomes a coin flip. Not surprisingly, the lower the difference is between lump summing and then dollar cost averaging. Again, not surprising here. The further out we get, 88% chance of lump summing winning if you're looking at dollar cost averaging over a longer period of time. And the difference is great as well. Once again, with a histogram, we see, again, things even skewed more towards the side of lump summing winning over here. Okay, we see that the majority of the results here where lump sum wins. We also see some losses over here, but at a lesser rate than we see in terms of, we see some losses over here, but we see at a lesser rate. There are less situations that this happens, and the overall loss is greater, is less than if we would have lump sum, and the gain that we get from lump summing, again, if that makes sense. Now, I'm not going to go over bonds here. If you want to essentially stop the, if you're watching the replay of this and you want to pause this and look at some of the data around bonds, basically you'll see that very similar things here. Bonds win 76% of the time on average. The gains and the whole asymmetric kind of trade-off is very similar with bonds as well. So I don't want to kind of beat a dead horse on this front, but even if you look at a safer asset class like bonds, we still see very similar metrics play out where bonds, again, lump summing into bonds wins the majority of the time. And so what about though Monte Carlo data? So I'm a big fan of not just looking at history, looking at historical data, and actually running this inside of a simulation. And so now when we're looking at running inside of a simulation, we're simulating 1,000 different months here. So we're looking at more data here. We're Monte Carloing this, meaning that we're simulating this data with historical stock returns, 10% returns with 16% standard deviation. And once again, we see the similar things play out. So it's not just history that is showing that lump summing wins because there's a sequence of return that makes a lot of sense in history. We see this with Monte Carlo data as well. And we can start to simulate a bunch of different kind of return metrics. Okay, if we look at 6% returns with 16% volatility, we can kind of look at the difference between lump summing as well as dollar cost averaging. Again, 63% of the time lump summing wins in the Monte Carlo data. The average gain is 8%. Average dollar cost averaging gain is only 4.3%. When lump summing wins, it has about a 9% advantage over dollar cost averaging. When dollar cost averaging wins, it has about a 6% advantage over lump summing. Okay, going further into this, again, we see that the histogram looks fairly similar, all things considered. So even when we start simulating data, we see the same ideas play out as when we're looking at historical data. That's good. That means that there's some statistical significance to the data that we're running. Okay, and so what are we learning here? Okay, on average, when we look at the black and white data, it seems that lump summing oftentimes wins, but there are some other kind of interpretations that we can take from the data as well. First, for instance, the shorter time frame, the shorter dollar cost averaging time frame that we're looking at, the more that it's about a coin flip. And again, this makes sense. The longer dollar cost averaging time, the longer it takes to invest that money in. And we're expecting our investments to grow. If we're looking at lump summing versus dollar cost averaging over 5 days, there's not going to be that big of a difference in the return as well as the risks that we're taking. Lump summing, again, can be more volatile by definition. This makes a lot of sense. Again, what is our goal here? Is our goal to risk mitigate as much as possible? Okay, well, we're really only risk mitigating in the time frame that we're dollar cost averaging. Once we're past that dollar cost averaging phase, we're 100% invested into stocks, 100% invested into a 60-40 in either scenario. So it's just as volatile for the vast majority of the time that you're investing. So I think this is a little bit of a point that is a little bit overemphasized, all things considered. Also know though, this is not a binary decision. This does not have to be we're taking money from cash and now we're deciding to invest this in the markets or we're keeping it in cash. Okay, here's an idea. Okay, that's kind of a in between on both sides. So what if we lump sum, but now we just dollar cost average into different asset? So what we saw based on the data that we were looking at is for a 60-40 portfolio, more of a balanced portfolio. And a balanced portfolio can mean any different things to everybody. We're obviously not big fans of bonds right now in the current interest rate environment, but it's nice to use that for historical data. There's a lot of historical data on bonds, obviously. And so we see that there's the least amount of risk in the trials that we looked at with investing in a balanced portfolio in terms of the kind of the risk adjusted return that we're getting. For every unit of risk we're taking, we're getting the highest growth there in terms of lump summing versus dollar cost averaging in a 60-40 portfolio. So what if we didn't dollar cost average from cash, but we dollar cost average from a balanced portfolio? And let's say we're trying to ultimately get 100% of the stocks. Okay, so why not lump sum into a balanced portfolio? And then rather than during every kind of period here, and I don't know why some of these aren't showing up, my apologies. Some of these should be showing up here where it shows that we're dollar cost averaging into stocks. But basically what we're doing here is we're starting 100% into a 60-40. And then rather than dollar cost averaging from cash, we're dollar cost averaging from the 60-40 into 100% stocks. And so now we're getting the benefits of lump summing, but we're still mitigating risk. And so it's kind of an in-between. It's not binary where we're looking at cash versus a risky asset like stocks. Now we're looking at already being invested in more of a balanced portfolio that we lump summed into. And now we're trying to decrease the risk that we have, the volatility that we have by slowly dollar cost averaging from, again, a balanced portfolio into stocks. That can be a much better kind of in-between for a lot of people because we still have that protection where in a COVID crash, again, that safety that we have in that balanced portfolio is going to mitigate some of that risk and some of that regret that we might have if we mistime things. Okay. But really, at the end of the day, is any of this surprising? Again, if we think about the core principles and the foundation of what we know, we expect our investments to grow. Okay. So the faster that we can get the money into investments, the better growth that we expect. We have a long enough time horizon by definition. This is money we don't need in the short term. If we do need that in the short term, we shouldn't be looking at investing that into riskier assets for growth. So we don't need that money for the long term, or we have a longer time horizon. So again, volatility and risk over that longer time horizon means less, okay? And then we know that time in the market is more important than timing the market. And so again, going back to that idea that we expect our investments to grow, putting $100,000 in today is better than putting $100,000 in over the next 12 years. It's better than putting $100,000 in over the next 12 months. It's better than putting $100,000 in over the next 12 weeks. Okay, none of this is surprising if we think about kind of the first principles, our ground principles, if we will, that we covered earlier, things that we have to assume. And so overall, we see that lump summing on average across many different investments lump summing beats dollar cost averaging. Okay. That being said, though, personal finance, I talk to this a lot with a lot of our clients. It's not just about the black and white data. Okay. Personal finance is a little bit personal as well as a little bit finance. Okay. The data, the finance part of it might say that lump sum investing makes more sense, but ultimately it's about what we can also stick with. And so our goal, as I kind of hinted at earlier, should be to get as close to lump summing as possible, but making sure that we can stick with the overall investment plan. So again, that might mean starting with a more balanced portfolio and then dollar cost averaging from there. That might mean for some people dollar cost averaging from cash, but doing so in a shorter amount of time, maybe over days period, weeks periods, trying to keep that dollar cost averaging period as short as possible. Because again, as we see, we expect to have the best growth from lump summing, all things considered. We saw that through many different trials. And so again, in terms, it's the same, it's very similar in terms of, should you carry debt right now? Should you carry a mortgage? Again, a lot of signs point to yes, based on our low interest rates. But if you're someone who's retired and you absolutely hate debt, and that's going to keep you up at night and sacrifice some of your peace of mind, well, then it might still make sense to fully pay for your house and not take a mortgage. Now, the math would say take a mortgage, all things considered with expected returns moving forward. But the personal side of finance can sometimes be at odds with the finance side of finance. And so there's often an in-between that we have to try to figure out for that specific client, for that specific person. But again, all things point to data, black and white wise, lump summing winning over dollar cost averaging. And if we are going to dollar cost average, we need to make sure that we're thinking about what time frame and just knowing in the back of our minds and keeping that data in the back of our minds that lump summing does outperform. Hopefully this was interesting. Hopefully you guys got another perspective and saw a lot more data in terms of this idea between lump summing versus dollar cost averaging. Always remember, you don't need more money. You need a better plan. If there's any questions as you're watching this replay, leave them in the comments below. If you're watching this on YouTube, hit the subscribe button down below, hit the like button. We appreciate the entire community that's been building on Facebook in our Retirement Mastery group, as well as on YouTube. Thanks a lot for watching. We look forward to seeing you in the next Wealth Wednesday.